Sorry about that. Good morning. So, um, so you're talking about equity valuation last time, and we were looking at the different types of models that were there for equity valuation. And we spoke about the fact that you can have different types of model, including free cash flow valuations, dividend discount models, relative valuations like price earnings ratios, right? But right now, we're concentrating on dividend discount models, where we're looking at the fact that anyway, the value of equity is equal to the present value of its future cash flows, right? But now, what are the future cash flows that we're considering? We're looking at the present value of its future dividends, because the rationale is, as an investor who's investing from the outside, right? Not as part of the company, but a person who's taking ownership of the company from the outside. What are your cash flows? Your cash flows are your dividends. Okay, so based on that rationale, we say the value of the company, how much it is worth to you, is the present value of your future dividends, based on certain assumptions, of course, because it can't be just your future dividends if you're looking at the price of the company, right? But assuming that this company is going to be a going concern forever, and that you're going to get this dividend forever, then you can look at the present value of future dividends to come up with the value of the company. So this is where we start. We spoke about in this context, when we said present value of future cash flows, dividends or cash flows or whatever that we're talking about. But when we say the present value, what is the discount rate that we're going to use? This discount rate, we call it a required rate of return. We call it our cost of equity. Cost of equity, right? Is generally, it's not that you can use what you want to, right? Essentially, your discount rate is your risk-free rate plus a risk premium to justify the risk that you're taking. Okay. The risk premium is different for debt. It is different for equity. It is a little bit more complicated for equity, which is why we use models like CAPM to come up with the effective risk premium. So CAPM is just one model. You have many, many models which you can use to come up with the discount rate, like the Farmer French 3-factor model. CAPM is what we call a 1-factor model, okay, where we essentially say, excuse me, our cost of equity, or essentially our required rate of return or expected return, is the risk-free rate plus beta into RM minus RF, right? This is what we call a 1-factor model, where we say the risk premium depends on one factor: how sensitive my stock is to the market. You can have 3-factor models. You will have multi-factor models that have been that many researchers have put out to say, this is the cost of equity, this is my required rate of return. It is not just the sensitivity to the market. It is about how big this company is, how liquid this company is, how it reacts to the economy, right? Depending on different factors that impact the company, there are different researchers that have put out different models. But the most common model that has been used, that continues to be used despite it having shortfalls, is the CAPM model, the 1-factor CAPM model, because it's easy to use, right? And it's enough for us to come up with adequate discount rate. And this is what we use as our most common cost of equity. Doesn't mean that it is the only way that you calculate your cost of equity. So ultimately, cost of equity is your risk-free rate plus risk premium, and how you come up with the factors that impact your risk premium. So beta is what? Beta is how sensitive my stock is compared to the market. versus RM minus RF is my excess returns over the market, my excess returns over the market. So using that, we spoke about a one period model. This is where we started, where we essentially said, when we look at the return of a company, the return of a company is its capital gains and dividends as a percentage of your initial investment. And this can be rewritten to say that the value of the company, sorry, let me be consistent here. The value of the company today is equals to dividends plus the price that we expect to happen discounted to today. Okay. Present value of my future cash flows, where my future cash flows are dividends plus price. So we use that as the base of the dividend discount model. We use the one period valuation model and we said, yes, but I'm not holding this stock necessarily for 1 year. What if I held it for 2 years, 3 years, and so on? And as a going concern, what if I held it to infinity? And this is where we come up with the dividend discount model, where we keep on looking at, without holding the stock for 1 year, 2 years, 3 years, 4 years, we look at n years, which approach infinity, right? And we said that in this model, if the dividends are equal to each other, right? If the dividends are equal to each other, then this equation condenses itself to D1 divided by my required rate of return or cost of equity. Same thing, just the notation, cost of equity. Okay? Cost of equity. So this model we call the no growth model, and you will see why we call it the no growth model as we go along today. Here we assume dividends are constant. There is no growth in dividends, right? There is no growth in dividends. The dividends in year 1 is the same as dividends in year 2, is the same as dividends in year 3. The most common type of example for dividend discount models is preference shares, where preference shares pay you a constant dividend forever if it is an irredeemable preference share, right? Remember, this is D1 divided by K. Technically, D0 and D1 are the same, could be the same, but if it is, in case it is not, then you must use next year's dividend because it's the present value of future cash flows, right? Also, last week, I think there was a question, I can't remember who asked it, but there was a question that's asked whether this was an annuity. It is an annuity. I said it was. It is, right? But it is technically an annuity that goes on forever, right? An annuity is a period of constant cash flows, right? A stream of constant cash flows. But it is an annuity that goes on forever, so therefore it is a perpetuity. And then, so that's where we stopped. Now we come to the constant growth model or the Gordon growth model. So, same argument. Value of a share is the present value of its future cash flows or future dividends, right? Present value of its future dividends, where we look at all the dividends it's going to get in the future and we discount it. In my second iteration, in my second scenario, in the first scenario, we assumed that dividends were equal. Based on the assumption that dividends were equal, we came up with the fact that the value of the share is equal to D1 divided by R, right? Now, we say, the next iteration, we say, what if dividends were not equal, but there was a relationship between the dividends? Dividends grew at a constant rate. Okay. Dividends grew at a constant rate. That means next year's dividend, right? Next year's dividend is equals to this year's dividend into the constant growth rate, right? So the growth rate remains constant. That's why we call it a constant growth model. Right? That implies that D1 is equals to D0 into 1 plus G. Similarly, D2 is equals to D1 into 1 plus G, right? But I know D1 is equals to D0 into 1 plus G. So therefore, D2 can also be written as D0 into 1 plus G squared, right? D3 can be written as D2 into 1 plus G, right? Because D2 growing at the constant rate, which can be rewritten as this D2 is equals to D0 1 plus G squared. So D3 can be written as D0 into 1 plus G to the power 3 cubed. So in a constant dividend growth model, what is the value of my company? The value of my company is next year's cash flow discounted to today. D2 discounted to today. Sorry, so D2 is actually D1 into 1 plus G discounted to today. Right. Plus D3 is actually D1 into 1 plus G squared discounted to today. And Dn is D1, D1 into 1 plus G to the power n minus 1 discounted to today. So what does this do? You can see that there is a common factor here. Yeah? So you can see here D1 is common. D1 is common, right? So D1 is common. We can take that out. We can take that out. And based on that, this equation will condensed. So we can take D1 out. And we can say this is 1 over 1 plus R, 1 plus G over 1 plus R, squared, and so on, right? And then this equation condenses to D1 divided by R minus G. R minus G. This equation finally condenses to D1 divided by R minus G, or in other words, D naught into 1 plus G divided by R minus G. Right? Because D1 is equals to D naught into 1 plus G. So what do we call the dividend constant growth dividend model. I'm erasing this. The value of my share today is equals to next year's dividend divided by R minus G, or same thing, today's dividend into 1 plus G divided by R minus G. Okay. Now to apply this equation, there are certain factors that you have to take into consideration. One is the fact that you cannot apply this equation unless the growth is constant. Growth needs to be constant. And growth needs to be constant forever. Forever. Growth can be constant for 5 years. Then we can't apply this equation. Growth can be constant for 3 years, 5 years, 10 years. Then we can't apply this equation. This equation can only be applied if growth rate of dividends is constant forever. Growth rate of dividends is constant forever, right? Also, you can see that to get a positive value here, this denominator component must be positive. Therefore, R always must be greater than the growth rate of dividends. Otherwise, we can't apply this equation. R must be greater than the growth rate of dividends. Okay. So this is what we call the constant dividend model, constant growth model. Sorry, not constant dividend, constant growth model. We also call it the Gordon growth model. Gordon growth model. Any questions? Okay. So based on this, R and K are the same things, remember. R is my required rate of return or cost of equity. Cost of equity. You'll see in a little bit why. But another equation that you would need to know to do these sums are sometimes how to get the growth rate. And the growth rate we say is my expected ROE or target ROE into how much I retain back inside the company. 1 minus dividend payout. So I'm looking at how this company will grow, right? To look at how this company will grow and look at the future earnings it can receive. Essentially, what do we mean by the future earnings it can receive? It is about how efficiently my capital, my equity will be deployed, right? My return are my future earnings. And it is based on my return or my future earnings that I will be able to pay out a dividend. Okay. So what is my growth? What is the growth inside the company? The growth inside the company is the return that I earn on my equity as a percentage of how much money I keep back inside the company to earn this return. So ROE is my target ROE, and B is what we call the plowback ratio or the retention ratio. It is equals to 1 minus dividend payout because it's about how much money I keep inside the company. Any questions? Oh, okay. So try the example. Let's see. Darren, just give me a minute, checking. Yes, Jaren, correct. Niraj, I think there is a decimal place error there, but looks to be in the right direction. I think it's just the entry error. Yeah, Divanka, yes. So it's, yeah, correct. Good, Sanila. So you can see here, it's quite easy, right? This question is quite easy. Of course, it doesn't necessarily tell you a couple of things. We are making some assumptions. We are assuming that this current RO is going to continue, right? And therefore, there will be constant growth forever, right? So if the current policy does not continue, we cannot apply this equation. So based on these only, we are doing this calculation. So assuming that the company RO is going to continue and the distributions are going to be, the dividend payouts are going to be in the same fashion and it's going to be forever. Based on these assumptions, we can use the Gordon growth rate model, the dividend or the constant growth model or the Gordon growth model. So first and foremost, it's a dividend of 3 rupees. So I know the dividend, but is this D naught or D1? Is this D naught or D1? Yes, it is just paid. That means it is happening today, right? So it is D naught. So it's about whether it's happening today or not, right? It's just paid. So this is D naught. So I need to find D1. To find D1, I need G. I need G. And I know that G is ROE into B. ROE is 20%. B. B, it says the payout ratio is 60%. So 60% of my earnings have been paid out as dividends. Okay. That's what the payout ratio means. How much of your earnings are being paid out as dividends, right? So if your payout ratio is 60%, that means your retention inside the company is 40%. Okay. So, Nimasha, I think there's something wrong there. The others are getting a different answer, and I think that answer is correct. Let's see. Let's just double check. So, what is your growth rate? 8%. 8%. Okay. So, we have come up with the fact that now the growth rate is 8%. Based on the growth rate of 8%, I can come up with what is D1, or I can use this equation to for everything. But now I need to know R, or my cost of equity. Okay. So what is my cost of equity? It is my risk-free rate plus beta into RM minus RF. Right. Risk-free rate, it says it's 6. Beta is 1.25. How much is RM minus RF? How much is the RM minus RF? Is it 2? 2 because RM is 8%, RF is 6%. Is that correct?
Should be 8%. It should be 8%, right?
Yeah. So why is it 8%? Because 8% is the excess return. What do you mean by the excess? Over and above the risk-free rate. So it is already RM minus RF that has been given to you, not RM. Okay? Over and above the risk-free rate. So 8% implies, oops, okay. So the answer is 16%. So now I know that G is 8% and K is 16%. Any confusions on RM minus RF? Anybody who wants me to explain that again? Okay. So now it's a simple matter of applying to the equation. I know D naught, I know G, I know K. So the value is D naught, 3 rupees, into 1 plus G, because it is D1 that should be inserted. If it is not D1, we should use D naught into 1 plus G divided by R minus G. And I think you all are getting 40.50. Is anybody getting a different answer? Nimash, is that okay? Okay. Right. So what does it mean? This says that if I pay a continuously growing dividend that grows forever at a constant rate, the maximum price I'm willing to pay for this company is 40 rupees, 40.5. The maximum price, remember? The maximum price I'm willing to pay for this company is 40.5 rupees. That's an easy example. Now we try to combine these examples and we go to the fact that don't even try to bother to look at this equation, right? Remember, the only thing you have to remember as we go along for the future sums is that the price of my share is the present value of my future dividends. The value of my share today is the present value of my future dividends. Okay. So based on that, let's look at a few iterations of how to work out the value of the company. Try the first question. If you have any questions, ask. No, Mirage, something, some small mistakes, looks like. You got that correct. Yes. Sorry, no one, I didn't see that, but it's not correct. Janani, no. Nimasha, no. I was a little distracted. I had missed a few. Sorry. So only one correct answer so far. Divankar is correct. Sorry, no. $39, no. So that's fine. Let's look at it now. Okay. 28, no. I think 28 and Tarindu, I think y'all are getting your market risk premium wrong. The interpretation of market risk premium, right? Okay. So the company will not pay dividends. This is where we are today. And for the first 3 years, no dividends. No dividends. Zanina, no. You have to bring it to today's value. Okay. And in the 4th year, there is a dividend of 3 that is paid. Okay. And then this dividend will grow at a rate of 6%. So the next year's dividend is going to be 3 into 1.06, 3.18. And so on. It will keep on growing at 6% forever, right? So from here, it grows at 6%. It's different. And from here, it grows at 6%. Forever. Forever. That's important. Indefinitely. So what would you pay today for this company? 1-year treasury bill rate is 10%. Market risk premium is 10%. And the company has a beta of 0.8. Again, Tarindu, I think you're using the market risk premium wrong. This is why your answer is not correct. What is the market risk premium? What is the market risk premium? Yeah, what do you mean by that? Market risk premium? Is that RM or RM minus RF?
RM minus RF. No?
Yes, RM minus RF. Yes, sir. Thank you. Sorry. So yes, it's RM minus RF, right? So I think some of you are using 10% as RM. Be very careful here with the wording. Now, earlier we said it is the excess return. That's also RM minus RF. Market risk premium, that's also RM minus RF. We have defined all of these here, right? So market risk premium, excess return. So be very careful in terms of what you are using. If it's RM, it is the return on the market, not the excess return on the market, not the market risk premium. It is the return on the market or the market return. So this is RM minus RF. And that's equals to 10%. So because of this, how much is my discount rate? Risk-free rate 10 plus beta 0.8 into RM minus RF 10, it's 18%. 18%, right? So now I know K. Now the question here is, the big question here is, how do I apply my constant growth model? How do I apply my constant growth model, right? I can do it two ways. But you tell me, how do I apply my constant growth model? It is not applicable for year 0, 1. It's not applicable, right? What is the first place that I can apply my constant growth model? Because there is a constant growth here happening. It's 6% and it is happening forever. So those conditions are met, but it is not met from year 0. So because of this, I have to figure out at what point can I start applying this model? From what year can I start applying this model? From what year can I start applying it?
Either year 4 or 3.
Yes.
Correct. Either year 4 or 3. Right. You can either use the fact that year 4 is D0, or it is also correct to use the fact that year 4 is D1. Because in year 3, there is no other dividend shown. And even if it is shown, the constant growth starts from year 4. So it is okay to consider that to be D1. So let's do the sum both ways. You see that you get the same answer. So again, I can use the constant dividend growth assuming that year 4 is D0, or I can assume year 3 is D0. I can do it both ways, right? Which one is more intuitive to you? Starting from year 4 or starting from year 3?
Starting from year 4.
Starting from year 4. So let's do that one first. And you see the other one also will give you the same results. So this is more intuitive, that's true. Because here you have a standalone dividend of 3 rupees, and that 3 rupees is now growing at 6%. So we assume that D0 is year 4, D1 is year 5, D2 is year 6, and so on. And it goes on forever. Right? So what does my dividend discount model say? My dividend discount model says the value of my dividend in year N, the present value of my dividends, or the price, I call it the price. The price of my share in any year is equals to next year's dividends divided by R minus T. This is correct, right? You understand that? because P naught is equal to D1 divided by R minus G. P naught is equal to D1 divided by R minus G. P1, for any year, I can do the same thing and say that then P at any point, the price of the share at any point in time is equals to next year's dividend divided by R minus G. Okay. So that's what I'm going to do. Dimash is still not, right? So now I'm using the fact that D naught is year zero. Sorry, what am I saying? Year 4 is equivalent to year 0, right? So I'm trying to find the price at this point. The price at this point. So based on that, what are we saying? We are trying to find the price at year 4. Yes, go ahead, Maheshika. Madhushika, sorry. Question? You have raised your hand. If it is by mistake. So,
Vindhya, sorry. If D naught is year 4, isn't year 3 because we always consider the current, like we are looking at from the current date, right?
so look at this, right? In this one, today, this was D naught, today, right? So the question is, what is today? Today is D naught, right? So because of that, you have to figure out what is today. So you can, whatever date that you can pick any date. Only that your number of calculations go up or down. That's the only difference that will happen. You can't pick year 1 or year 2, but you can pick year 3, year 4, year 5, year 6, any year that you want to, right? Up from year 3 to take it as year 0. So now what happens is, when I do this, I am excluding all of this. So that's the second method I said. What you're mentioning is the second method I said that we will discuss. Right? So excluding all of these years before me, I'm saying this is year 0. So when I look at this is year 0, this is year 1, this is year 2, and so on. Right? So P0 is effectively P4 and is equals to D5 divided by R minus G. So what is D5? D5 is 3.18. Divided by R. R is 18%. Minus G. G is 6%. So I get that the price in year 4 is equal to, how much does this come to? $26.5. Thank you. Now, if today was year 4, if I am in the future and I'm in year 4 today, is my company really worth 26.5 rupees? If today, just forget about the first 3 years and imagine that today this is all happening. So in the 4th year is now today. And look at this question again and think of this as today. 4th year, there is no 4th year, that is today. First 3 years are now, that sentence is out. So is the value of my company today, which is in year 4, 26.5? is it correct to say the value of my company today, as in today being year 4, is equal to 26 rupees and 50 cents? Is it correct? Am I missing anything or not? No. I agree with you, Charlie, that it should be discounted. But here we are looking at the fact that today is year 4. Today is 2028. We are in 2028 right now. Is the value of my company 26.5? So how much should it be? You were a little unclear. You said no. And then what did you say? Year 5 and above. Year 5 and above. Not just year 5 dividend. Year 6 dividend has been considered, 7 dividend has been considered, 8 dividend has been considered. How did this equation come? This equation came as the condensed equation for the present value of my future dividends. So all of these dividends have been considered. Which dividend has not been considered? It is the present value of my future dividends. So therefore, one dividend has not been considered. Yes, today's dividend, which is the 4th year dividend. That 3 rupees has not been considered. We did the same thing when we did bond valuations, if you all remember. Remember, in bond valuations, we want to value a bond in between interest payment dates, right? In between interest payment dates, what did we do? We valued the bond, the present value of its future cash flows, to the interest payment date. Okay. We valued it to this point, to the interest payment date. Then what did we do? We said we had not considered this coupon because we had only considered the future coupons. So what did we do then? We had to add the coupon in year 0 or as at the interest payment date. So to the price, we add the coupon of that day. And then we had to bring that down to today's level. And this is exactly what we're going to do with this calculation as well, right? In bond calculations, if you remember the very last set of calculations that we did, and you all should remember because in 1 month you all are having your exams. The very last set of calculations we did was the most complex one, where we said we look at in between coupon payment dates. So it's the same way. We look at what is the value of the bond at a certain point in time. But the value of the bond as at a certain point in time only takes into account its future cash flows. It does not take into account the cash flow of that point in time. So when I want to bring it down to today's value, I have to take into account the cash flow at that point in time and then discount it down. So similarly, you see here, the price, the value in year 4 is the present value of my future cash flows plus the dividend that I will receive in year 4. So the value of my share in year 4 is actually 29.5. Questions? That's the value of my share in year 4. Now, what's the next step that I have to do? I have to bring it to today's value. How much is this share worth today? What should I do? in year 4 in 2028, if nothing else has changed in this company, the share is going to be worth 29.5 rupees. Today, how much is this share worth? What should you do? For 4 years, exactly. You have to discount the value in year 4 for 4 years. So you take the 29.5, the value of the share today is equals to the value of this 29.5 discounted to today. So 29.5 divided by 1 plus R to the power, R is 18% to the power of 4. Correct, 15.215. Okay, questions? That's correct. This is a cum dividend price, correct. But if you are looking at the future, it's never going to be ex-dip, no. It's always going to be cum dip because that dividend has to be taken into account. Other questions? This is one method of doing it, right? This is one method of doing it. You can also do the same sum now for the first 4 years, 3 years. No dividends. 4th year, there is a dividend. 5th year, there is a dividend. Right. So there is a dividend of 3 rupees, 3.18 rupees, because it's a 6% growth. And so on. There are dividends as you go on. Forever. So this forever is important, otherwise you can't use this equation. And if the growth is constant, these dividends are growing at a rate of 6%. So there's another way you can do this. Now, earlier what we did was we said that this was D naught. This is the first dividend. So this is D naught, right? And then this is the next dividend. This is D1. Because the growth starts from this point. The growth starts from this point. Okay. Constant growth starts from this point. Therefore, this is D1. That's what we did earlier. Now, let's look at it a different way and say, growth has already started. This is next year's dividend, D1. This is D2. This is D3 and so on. So our assumption is that now year 4 is D1. Year 4 is D1. So what is year 0? Year 3. Year 3. So now what will happen? I can apply the Gordon growth equation, the constant growth equation, from year 3 onwards. Earlier I applied it from year 4 onwards, right? Now I apply from year 3 onwards because these are all my future value, future cash flows. These are all my future cash flows. So what do? I condense all these future cash flows and say today, all these future cash flows are worth how much? D1 divided by R minus G. This is the value of my share as at year 3. As at year 3, the value of my share is the next year's dividend D4 divided by R minus G. So D4 is 3 rupees. R is, how much is R? 18, no? 18 minus G was 6. How much is this? Correct, 25. So the value of my share in year 3 is 25 rupees. Now for this, do I have to make any further adjustments for this sum? No. Right. Because there are no other dividends that I receive in year 3. So now what's the next step that I have to do? What's the next step that I have to do? I have to find the value of my share today. So what do I have to do? Discount it for 3 years. 3 years, correct. So this V3, I have to discount for 3 years to bring it down to year 0. That means it's 25, I have to discount for 3 years at 18%. And you see the answer you get is 15.215. Same answer as before, 15.215. That's the original answer you got. So you see, both methods will give you the same answer. You can actually do this for year 5, year 6, year 7. You'll get the same answer, 15.125. The starting point, what you have to figure out is from what point can I start applying my dividend discount model, my Gordon growth model, right? From what point can I start applying my Gordon growth model? It is correct to start applying it from year 3 onwards, anytime. Year 3 assumes that year 4 is the first dividend that you get on the Gordon growth model. Year 5, if I apply in year 4, I assume that year 5 is the first dividend I get. Then I have to add year 3 before I discount it. If I take year 5 as 0, that means year 6 is the first time I apply the Gordon growth model. Right? So that's D1, year 6. I discount it to year 5. I have to add year 5. Discount that. Plus, there is another dividend in year 4, which I have to discount separately. So the question is, what is the first point that I can start applying the Gordon growth model? What is the first point I can start applying the Gordon growth model from? In this question, year 3. Okay. Year 3, it is okay if you want to, if it's clearer for you to apply from year 4. Okay, you still get the same answer. Not a problem. But the easiest application comes from year 3 onwards. Year 3 onwards. Is that clear? Any questions? Okay, too confused? What is the problem? Okay, so let's look at the next one. Sorry, what does it mean by the growth rate is expected to settle at a long-term rate of 5%? That means that it will indefinitely grow at 5% forever. So meaning, because earlier you can see here the growth rates and for the beginning years is 20%, right? 20% is not a sustainable growth for any company. Imagine a company that keeps on growing at 20% rate forever. I mean, that can't happen. The company will be bigger than the entire universe of companies that are there, right? It will dominate the world. So that can't happen. So long-term growth generally of a company settles down between like somewhere around GDP growth or lower than GDP growth-ish levels, because you're looking at how the economy is growing and how this company will perform relative to the economy. So when we talk about long-term growth, we talk about sustainable long-term growth, and we figure out whether this company is going to perform better than the economy or lower than the economy or equal to the economy. And we, based on those targets, we figure out, okay, what's the type of growth rate that we want to say that this company will have forever, right? So the first few numbers are easier to forecast, which is why in these multi-discount models, multi-period models, these types of models, we call them multi-period models, right? Because you have different growth rates for different periods. That's because usually the first few periods are easier to forecast. But as you go along a company, what they will do forever into the future, we don't know. We can't say. So because of this, we have to come up with an assumption. And which is what we say generally, the growth is expected to settle at a long-term rate of 5% means that forever, the company will keep on growing at a rate of 5% per annum. Raj, let's see what your answer. This is an easy one. Okay, so I'm going to wait a couple of minutes for the others to come back with their answers. Okay, Janani and Niraj, you have two different answers. Waiting for a consensus. Based on A being correct, B is correct, Niraj. Okay. So it looks like Tivanka and Janani are getting the same answer. I assume that's correct. Other? So let's look at the numbers. So you had just a dividend paid of 2 rupees, right? The dividend was just paid. So I'm just going to leave that aside. That's not going to impact. That's not a cash flow that I'm getting. It's a dividend that has been paid, right? But I need that to do my rest of my cash flows. So this 2 rupees next year is going to grow at 20% and become the next year's dividend is expected to be 2.4 rupees. I hope that's right. And then the year after, again, it will grow by another 20% because for the first 4 years, your dividends are expected to grow by 20%. So, what are the dividends, please, that you will get for the next 4 years or for the first 4 years? What are the dividends you will get? Yes. What are the dividends in the first 4 years? Nimasha, your answer is line 3. Okay, I think you're taking you're considering, how can I say it without giving it away? Yeah. Zarina, no. Thank you, Janani. 2.4, 2.88, 3.456, and 4.147. So these are the dividends that you're expecting to get at a 20% growth for the first 4 years. So first 4 years, dividends are growing by 20%, right? So from 2 to 2.4, from 2.4 to 2.88, from 2.8 to 3.456, and then to 4.147. 2.147. That's for the first 4 years. After that, growth is expected to be 5%. The long-term growth rate is expected to be 5%. So that kind of gives you a hint. Okay, from this point onwards, forever, these dividends are going to grow at 5%, right? So if I look at what is my next dividend, that's going to grow at 5%, right? And from there onwards, all my dividends are going to keep growing forever at 5%. Right? So what's my next dividend from 4.147 at 5%? My next dividend is going to be 4.354. And now it's asking, what is the maximum price you would pay? So I had to figure out, okay, what is the price of the present value of all these dividends? That's it. Okay. It's simply a matter of discounting. So how do I do that? Now, all of these dividends, right, including this, I had to look at a constant growth. This I can apply the constant growth model to come up with what is the value of this set of future cash flows, right? So now the question is, what is the first point I can apply the constant growth model to? Is it year 1, 2, 3, 4, 5, 6, 7? What is the first point I can apply the constant growth model to? Yes.
Year 4, right?
Year 4 is 0 or year D0? Right. So year 4 D0 is something that you can consider. That's correct. D0 to be year 4. Or you can consider D3 to be year 4 as well. Okay. Remember, so if it's confusing you, you use year 4 to be D0, right? Because both answers will be the same. Don't do anything that confuses you. But based on what we did earlier, the earliest point you can apply and get the same answer is year 3. So that means
4, right?
D0 being year 3 and D1 being year 4, these are my future cash flows. Right. Future cash flows. So if I apply, that's the first point. From that point onwards, any point is correct. So 4.147 to be D1. We consider D1. So therefore, what is the present value of my future cash flows? All of these future cash flows are going to be considered and looked at. What is the value of all of those future cash flows as at year 3, right? So the price of all of those future cash flows in year 3 is equals to D1 divided by R. What is R? 15 minus G. What is G? 5. Right? So 41.47. So Sarila, that's the answer you got, but that is not a complete answer, right? 41.47. Now what's the next step? What's the next step? Is this actually the value of the company in year 3? Yes. So you have to now add the year 3 dividend to find the actual value of the company in year 3. So the year 3 dividend of 3.451. So now if I look at my cash flows are actually 3 cash flows. In year 1, I get 2.4. In year 2, I get 2.88. And in year 3, I get 41.47 plus 3.451, 44.921. Right? And now I have to discount each of these cash flows to today to get the value of the company. Right? So 2.4, I write it separately. 2.4 discounted by 1.15 for 1 year, 2.88 for 2 years, and 44.921 for 3 years. And is it correct? Is that what you all have done, Tivanka? Is that the answer you get is doing that? 33.8056?
Yeah.
056. Okay. So if you all are getting confused, apply D0 to be year 4. It's only one more. What will happen if you apply D0 to be year 4? Then you will find the present value of future cash flows will be 43.54. Because this is 10, it's easy, right? 0.15 minus 0.5 is 10, no? So it's easy. So the present value of your future cash flows will be 43.54 plus 4.147. So you will have to discount 4 cash flows, 2.4, 2.88, 3.451 plus and 4.147 plus 43.5. And you discount those 4 cash flows at 15% to today's value, and you should still get the same answer. Any questions?
Don't we need to add that first 2 rupee dividend?
Okay, good question. You tell me, that 2 rupee dividend, is that relevant or not? What does it say here? How is it worded? That wording is important. That's why I said it's a good question.
I just paid. Sorry, it just paid.
Just paid. So it's in the past. It is not a future cash flow, right? So therefore, it is not relevant. That's why I put that down here. I didn't put that up there. It's the base I need to carry out my calculations, but it is not a relevant cash flow. It is not something that is happening in the future. But part B asks that question. How would your answer change if the 2 rupee dividend was not yet paid? It's about to be paid. Then what would happen? Part B. What's your answer for part B? Absolutely. So then for part B, your 2 rupees would also be a cash flow that would happen. It would happen, it's a cash flow that happens in year 0, right? It's a cash flow occurring in year 0 because it hasn't been paid yet. It's something that's not in your hands. So you would get it. So it's a future cash flow, right? So that 2 rupees also then should be taken to consideration for part 2. And for part 2, the answer will then become 35.8056. That's the answer for part 2. So this is the difference between, remember when we talked about whom rights and X rights? Similarly, we can talk about whom div and X div. This is the whom div price. Whom means with. This is the X div price. X means without. So cum div versus X div, right? With the dividend as a future cash flow to be paid, or without the dividend as a future cash flow because it has already been paid. Okay. So cum div price is with the dividend. X div price is without the dividend. Generally, when we do calculations and you have to read the wording, if the dividend has been paid, that means it's X div. The company doesn't have that cash flow inside it, right? It's very like intuitively what is actually happening. The company either has cash flows inside it to pay you or it doesn't. So the company doesn't have the cash flows inside it if it has paid the dividend. So then we shouldn't value that cash flow, right? That's why we don't take the 2 rupees in my X div price. But if I say cum div, that means I haven't received it to my hands yet, or I am not entitled to it. Remember, I don't really need to receive it to my hands. If you remember the sequencing we talked about in rights issues last time or the time before, we said there is an X rights date. Doesn't mean that you get the share to your hands, but you are entitled to it. As soon as you become entitled to it, it's like you have got it. It's like you have got it, right? So XDiv is the date that you become entitled to it. So then you can take it as if you have got it. So that's already received. As if you have got it means it's already received. Doesn't mean the cash payment would have hit your account, but you can take it to consideration in your calculations because it is like you have got it. Cum div valuation versus X div valuation. So if you start to pay 35 rupees to buy a share, understand you're never going to get that, you're never going to recover that 2 rupees. So that's what's important. If the dividend has already gone X div, you're never going to get that 2 rupees. So you're overpaying for the share. Any questions? Okay, last part. So here we are saying today is 2024. In 2026, what is the value of this company? If the company is going as it is, the dividend policy has not changed, right? So all these dividends are expected to occur just like it is. What is the value of this company in 2026? That's very easy. I have no colors. The last part shouldn't take this long. Okay. One second. Okay, looks okay. Ivanka and Imasha getting the same answers. Right. Right. So because there's not a lot of space here, let's go to a new. Ravindu, yes, same answer. Can somebody tell me the numbers here, please? 2.4, 2.88, 3.456. You don't need to do everything again. I have to because I'm rewriting the question. That's all. 4.147. And what was the last one? 5-year, because these were the 20% growth rates. Right. These were the growth rates at 20. And then when it became 5, what was the value, please? 4.354. Okay. So what did we do? Sorry. Now we are in year 2, right? This was starting from year 0, starting from a 2 rupee dividend that was paid. Okay. And now we are in year 2. We are here. This is today. Okay. That means everything else is in the past. Before year 2, everything else is in the past. It is not relevant for us. Okay. So all of these you can forget. This is the only part that is relevant for us from this point onwards. We are here. We are in 2026, right? So from that point onwards, I'm looking at what is the value of my company today based on no other information changing. So I have done all the work that's necessary. The only thing now I have to do is the fact that I have done all the work that's necessary because we know that in year 3, the present value of all of these future cash flows, right, was equal to 41.47. And then I had to add the year 3 cash flow to come up with the cash flow in year 3, total cash flow in year 3 to be 44.946. I think if I'm wrong, tell me, right? 44.946. Now it's asking what is the value of the company in year 2? That's it. There are no further cash flows. There's all of these cash flows all of these cash flows have been condensed to 41.47. There is a cash flow of 3.456 occurring in year 3. Right? In total, I have one cash flow. When I'm standing in year 2 and looking ahead, I have one cash flow that I'm expecting of 44.946. So what should I do? I should discount this 44.946 to today, meaning discounted at, what is the discount rate? 50%, no? 15%. For how many years? 1 year. 1 year, right? When I discount it for 1 year, what's the answer you all are getting? 39.083. Is that the answer? Is that the answer? Yes. This is the ex-div price. This is the answer if the share was trading ex-div. If the share was trading ex-div, then this 2.88 wouldn't have been taken to consideration. But because it is trading cum-div, it has to be taken to consideration. So the cum-div price, you had to add that 2.88 to get 41 point. Is it 963? All of you all are getting 947. What is the reason? Did I make some mistake?
The XD price, is we are getting, at least I got 39.067.
067. Okay. But this is what you all used, right? 44.946 or 928. $41.47 plus 3.456. 926. Okay, divided by 1.15. $39.067. That's the ex-div price plus 2.88, 41.947. And that's the answer. Okay. Any questions here? Right? So for a dividend discount model, you can see, remember, if any of you all tried to look at the cash flow that you all, the price that you all got here and tried to bring it forward, that is wrong. Okay. If by any chance you all took this price that we calculated earlier and then tried to bring it forward for 2 years, that is wrong. Because you're looking at the present value of future cash flows, not the future value of present cash flows. Okay. Any other questions? Okay. Can we? This is not a difficult question. Can we quickly try this before we take the break? It's a matter of putting the numbers. After that, it's not difficult at all. Just quickly try this and then we take the break. Once you put the cash flows, it's very easy. Let me know if there are any questions. There are questions, please ask. Okay, Nimasha, waiting for the others. Okay, Tivanka, Nimasha, same answers. So it's cumulative, right? Meaning the dividend has not been paid and it's 5 rupees. So in year 0, there is a dividend we have to consider. We are getting 5 rupees. Over the next 2 years, it's estimated that the dividend would decrease by 10%. Decrease, right? So this 5 rupees goes down to, you have to take 90% of 5 rupees to 4.5 rupees. And again, 90% in the third year, in the second year. So in the first year, you get 4.5 rupee dividend. In the second year, you get 4.05 rupee dividend. Okay, Ravinu, there is a slight difference between your answer by about 0.25, 25 cent difference between your answer and the answer the other two are getting. Just double check. And then it says third and fourth year, no dividends. 0 in the third year and the fourth year. From the fifth year onwards, it estimates that it would be able to receive dividends at the same level as the final dividend paid. So that's 4.05. So in the fifth year, you pay a dividend of 4.05. And that dividend can grow at a steady rate of 6%. Steady rate, right? So again, that is your hint to say that this is the constant growth that you will see. So steady rate of 6%. Right. And it will keep on growing at 6% forever. So 4.05. Was there a question that was asked? Into 1.06, 4.293. So in the first 2 years, there was a negative growth, right, of minus 10%. But now you have positive growth of 6% forever. Now, the first question is, and then after that, investors required rate of return is 16%. What is the maximum price? So to apply, because you have a steady growth of a 6% dividend forever, right? What is the first place that you can apply the Gordon growth model? First instance that you can apply the Gordon growth model. Year what? Year 4. Yes. Year 4 is the first instance. If you all are getting confused, apply it to year 5. That's okay. Remember, you will still get the same answer. Just make sure that you're in line. So year 4 is the first place that we will apply the Gordon growth model. So this is year 0. Okay. And all of these are my future cash flows. And all of these cash flows can be condensed to one cash flow of 4.05. That's D1 divided by R minus G. Right? 40.5. So now when I look at my cash flows, in year 0, I have 5 rupees. In year 1, I have 4.5 rupees. In year 2, I have 4.05 rupees. 0 rupees in year 3 and 40.5 rupees in year 4. Pravindu, you're still partially there. Oh, nice, correct. So now what do you have to do? You have to discount these cash flows and add it. Right, 4.5, you discount at 16% for 1 year. Add 4.05 discounted for 2 years. Add 0 discounted for 3 years. And 40.5 discounted for 4 years. And plus, do you take this 5 or not? It's cum div. So you have to take that into consideration. So add that also. And I'm told you're getting 34.2569. Is that correct? So this is the cum div price of the share. So you see, equity questions are easy to the extent that once you draw the cash flows, like you draw the cash flows correctly, then it's a simple matter of discounting it, right? So the complication is about drawing the cash flows correctly. So if you get a question on dividend discounting, it's not a difficult question as long as you draw the cash flows correctly. Any questions here? Okay. So let's take a break. It's 10:20. So guys, I have a small problem. I have a unexpected emergency errand that I need to run. I had to step out. So I'm expecting half an hour to 40 minutes. I'll be back. So can we please reconvene at 11 o'clock and give me a little bit of time in case I get late? Just give me, because this is a small emergency that has popped up that I need to just attend to. So I'm just going to step out and come back within about half an hour to 40 minutes, right? So it will be a long break at 11 o'clock. I'll try to be back by 11 o'clock.